Hello, welcome back to the show. So in today's video, I'll be talking about how exactly to avoid picking bad stocks. So in today's video, we'll be covering a few things. We'll be covering how to avoid picking bad stocks, the biggest risk in finance, healthcare stocks, as well as some questions that you guys have left me in the comment section below. So let's talk about the fundamentals of a business first. So in the long run, your fundamentals will always lead to stock price appreciation. Your stocks, they are a voting machine in the short run, but in the long run, they are a weighing machine. Meaning to say that over the long run, your stock price will eventually catch up to your fundamentals. So what exactly do you look for in a stock? So when it comes to picking stocks, what you want to look out for is a perfect intersection between predictability and growth. So you want predictability of this business, meaning to say a company's ability to defend its market share and grow its total addressable market, and it is a necessity of a product. As for the growth of the company, you typically want companies growing at between 10 to 20% or so. You don't want companies growing too fast. You also don't want companies with no growth. So let's talk about a company over here that doesn't fit the metrics earlier. So this company over here is Procter & Gamble. Procter & Gamble is a highly predictable business. You know almost with a great level of certainty what they will earn next year, what they will earn next year, and what they will earn in the following year as well. But the problem with this business is it is not growing at all. So if you're to look at the earnings over here itself, the revenue growth has been around 2% over the past 10 years or so, 2% CAGR, and they barely can beat inflation already. So if you buy into all these stocks, the problem with these stocks are they cannot beat the market, first of all, and they cannot even beat inflation. So this is one example that you don't want to invest in. Next example is a company that has low predictability. So this is Grab over here. Grab has extremely high growth. It has very high growth, but there is a lack of predictability over here. So as you can see, revenue has been increasing almost every single quarter at an exponential rate. But the problem with this business is it doesn't have a history of showing good profitability. In fact, Grab is not even profitable yet. So when it comes to picking stocks, you want to pick stocks with a great level of predictability. And an example of an investor with an incredible investment methodology is Dev Kantesaria. So let's take a look at his portfolio first. So this is Dev Kantasaria's portfolio. So he has about 9 holdings in here. He has FICO, S&P Global, MasterCard, Moody's, Visa, Intuit, ASML, Equifax, as well as MSCI. So all these stocks over here, they're incredibly monopolistic business. FICO is a monopoly in your consumer credit rating portion. S&P Global as well as Moody's, they are a duopoly in your credit rating portion. In terms of all your different companies trying to raise debt, MasterCard and Visa, same thing, they are a duopoly in your payment processors. Intuit is a monopoly in your taxes. ASML is a monopoly in the EV segment. Equifax is almost a monopoly in terms of your employment data over here. And MSCI is in a duopoly with S&P Global in terms of its indices. So this portfolio over here is just incredibly high quality. Almost all these businesses over here are long-term holds for him. So this is what Dev Kantesaria has previously said about buying predictable and growth stocks.
Sure. So my inspiration, the playbook that we employ at Valley Forge, all derives from Buffett Munger. I've been studying public equity since I was 8 years old, so that's a very long time at this point. And I wish there were easier ways to make money. I wish I could trade gold bars. I wish I could predict where the price of oil was going to go. I wish I could invest in Bitcoin at the right time or just ride a momentum stock. But as you look over time, what works and also what's tax efficient, which matters in long-term investing. There's no playbook better than the Buffett Munger playbook. And that playbook is quite simple to describe. You own very high quality businesses. We define quality as finding the perfect intersection between growth and predictability. You can have companies that are growing very fast, like a young software company, but you're not sure of where it's going to be in 5 or 10 years in terms of market share or industry dynamics. Or you can find a company that's extremely predictable, like Nestle or Hershey, but they're growing organically at only 2 or 3% a year. In neither one of those situations deliver strong returns over the long term. If you can find companies that are growing at a much higher rate, but predictable, those are the types of compounding machines that you want to own. One of the favorite things that I own is an annual report from Coca-Cola from 1928. That report I like in particular because it has a lot of graphics, and it shows the volume growth of Coca-Cola from when the company started through 1928, and just unbelievable growth. They also show per capita consumption of Coca-Cola. So in only 6 years, the amount of Coca-Cola per capita in the US consumption doubled. Man, I can't think of a product where in 6 years it's used twice as much as it was than before. And so you look at what Coca-Cola represented in 1928, it was obvious for everybody to see, why were people not piling into Coca-Cola? Was it valuation? Did they feel like it had saturated its market? But what Coca-Cola had was another 50 great years ahead of it. We're trying to build a portfolio that on a weighted average basis can grow in the high teens to low 20s over the next decade, but can do it in a very predictable way. And if you look at the average, the median S&P 500 company for the next 10 years, it's going to grow in the low single digits organically. And so we have a portfolio that we think can grow 4 times as fast, but to do it in a very predictable manner. And so finding that type of organic growth is, again, we're trying to predict the future. And so it's great if others don't agree with us because we're not trying to figure out the best way to make money over the next year or two. We're trying to find the best way to make money over the next 5 to 10 years.
So, as what Dev Kantasari has said, he is extremely long-term focused. He wants to find companies with high predictability and high growth as well. That is the perfect high-quality stock that you should be owning. So now I'll be talking about some mistakes that people make when it comes to buying a stock. So the first mistake that people make is just simply chasing all your hype stocks. So this is Tesla over here. So Tesla in 2021, it raced up. It went up, I believe, around 500% in the span of 2 years or so. And at an all-time high price, it was trading at around $400. So fast forward 4 years later, the stock is now at around $300. So if you bought at an all-time high price, which I did at that time, I bought it at around $300. That was my first stock that I invested into in around 2021 or so. So for Tesla over here, if you bought like I did back in 2021 or so at around $300 a share, currently now you are breaking even. I sold my Tesla stock, I believe, at around this price over here. Somewhere after the bear market in 2022, I held it all the way through and then it recovered all the way until $270. That was when I entirely sold my position without knowing anything. I was lucky. I got out at maybe a break even, or maybe I lost a few percentages here or there, but I was extremely lucky with this one. I did not understand the business at all and I invested into this one. And overall, if you're chasing hype stocks all the time, you will eventually lose to all the big sharks that are trying to take money from retail investors. Next mistake that people commonly make is buying commodity stocks. So oil stocks, for example, oil stocks are extremely commoditized simply because they can only compete on price. So it is the same for all your different pharmaceutical stocks as well. So a lot of your pharmaceutical stocks, the problem with them is once their patent expires, the drug itself becomes a commodity and all the companies can do is to just compete on price to basically increase their market share over time. It is the same in the EV segment where all your different car companies, they're trying to lower prices so that they can gain a greater market share. So when a product is commoditized, it leads to price wars, and price wars typically leads to margin decreases. That is when a company's competitive advantage is challenged, and that is when you should be selling your stock. Next mistake that people always make is focusing too much on growth and not on the valuation and the sustainability of the business. So Warren Buffett just said that he looks more at the balance sheet of the company as compared to the income statement because your balance sheet determines the longevity of a business and the growth in a business won't be sustainable if a company has a weak balance sheet. So it is a common mistake from people to just focus too much on growth and neglect the downside. So an example today is a stock called Palantir. So Palantir over here is a company that's trading at around 500 times earnings. I'm not saying this company will go down in the next 1 year, 2 years or so, but this company at its current valuation is pricing in a lot. You need the company to grow at around 40% revenue growth every single year for the next 10 years to justify this valuation, something that no company has done before in history. And so for Palantir over here, I think it is a hype stock that people are piling money into simply because there's retail hype around it. So this is ARK, the hype ETF in 2021 or so. So in 2021, everyone was talking about how ARK Invest is the greatest thing ever because Cathie Wood, she basically invested in Tesla and all your different innovation stocks over here. The stock went up around 180% or so. And currently now over the past 5 years, this stock is down at 18% or so. So from all-time highs, this stock is down, I believe, around 60% to 80% already. And if you're to look at the list of ETF managers that have destroyed the most value, one of the greatest one out there is Cathie Wood. So Cathie Wood has been hyping up all her growth stocks, all while getting a fee from backholders. And this is what you see when that happens, when people just chase hype stocks. So in summary, focus on high quality predictable businesses that have strong competitive advantage and decent growth. Aim for companies with around 10 to 20% growth and in industries with minimal competition and with a wide moat. The moat is extremely important. It determines whether or not a company can sustain its operations over the next 10 years, 20 years or so. And normally you want your portfolio to have around 10 positions. That is normally the sweet spot for you to get outside returns in terms of the markets over here. Next portion, I'll be talking about the biggest risk in finance. So the biggest risk in finance is not the markets itself, it is normally just one's actions. So everyone is prone to making these mistakes, and that is why we will have to introspect. So the first mistake that everyone makes is price anchoring. So price anchoring is when someone says that, oh, the stock has gone down this much already, it can't go down anymore. That is price anchoring. Same thing when the stock has gone up. So for example, let's say if you want to buy a company that is deeply undervalued and then the stock runs 10%, humans will tend to price anchor because you bought the stock at 10% below current price, but this stock over here is actually trading at a discount to its intrinsic value. So instead of buying, humans tend to not buy because the stock has already run up 10%. But if you're to think rationally, you should be buying this stock because the intrinsic value is still much higher than the share price it is today. So this is price anchoring, one mistake that everyone makes. Next mistake that people always make is confirmation bias. So confirmation bias is when you seek for information to confirm your own beliefs, all while ignoring all the other facts that are true to this stocks over here. So for example, Tesla back in 2021, everyone was talking about how the Tesla stock is becoming the next biggest thing. So I even remember telling my investor friends around me that Tesla is going to continue growing at 40%, and then the next year the growth slowed to around 10%, and currently now it's having negative growth. So for Tesla over here at that point in time, those investors, they had high hopes, they ignored all the facts, they ignored the competition, they ignored the high valuation, and all they did was they tried to confirm their bias by having Elon Musk basically hype up the stock constantly. So this is another mistake that you don't want to make when it comes to investing in stocks. The third mistake is loss aversion. So loss aversion is when someone holds on to a stock for too long simply because he wants to break even. So normally humans, what we want to do is we want to make sure that we don't lose a single cent, and that could lead to you holding on to a stock for longer than expected, which leads to even more downside risk. So all in all, when a company's competitive advantage disappears, that is when you should be selling a stock already. Last mistake that investors normally make is something called herd mentality. So herd mentality is buying whatever is popular without caring so much about the underlying business quality. So for example, in 2021, Tesla, GameStop, AMC, all these stocks were meme herd stocks and everyone was piling money into it, despite the fundamentals not justifying its stock price. So even Dogecoin at one point, which I bought into as well because I was a follower of Elon Musk back in 2021. So I bought into Dogecoin as well and I lost quite some money in it, and it taught me a lesson. So don't follow this herd mentality over here. Make decisions regardless of the herd, because in the short term, your stock market is a voting machine. In the long term, your stock market is a weighing machine, like we said earlier. Next portion, I'll be talking about healthcare stocks that looks cheap right now. So the first healthcare stock is Elevance, second one is United Health, third one is Novo Nordisk. So for Elevance Health over here, it is one of the largest insurance provider in the US. The PBM segment of the business grew around 17% year on year in Q1. So it was incredible growth for this business, and it is currently now trading at around a 12 to 13 times earnings, which is much lower compared to its history. And for Elevance Health over here, I think the business in general is quite decent, but the problem is the company lacks a moat. United Health is a better option for me, and it's currently now trading at a similar valuation as well. So in the insurance segment, I would like to invest more into United Health instead of Elevance Health, although Elevance Health looks quite intriguing as well. As for Novo Nordisk, this company is quite cheap right now. So they're selling the highest growing drug in the entire world, which is your weight loss drugs. And the patents expire in 2031 and 2032 in the US itself. So there is still quite a long runway for growth over there. But the problem in Novo Nordisk is simply just the narrative itself. Everyone is focusing too much on the competition with Eli Lilly and whether or not Novo Nordisk can still hold its market share. And once the drugs patents expire in 2031, then all your different drugs over your Ozempic and Wegovy, they will become commodities where Novo Nordisk will just compete on price with all your different other pharmaceutical companies, which is what you don't want to see over here. So for Novo Nordisk, I don't understand the business enough, and I want this stock to go down to a price where I have a great margin of safety so that I can invest into this one, although it looks fundamentally and intrinsically quite undervalued right now. Last portion, I'll be talking about some questions that you guys have left me. So the first question over here, it says, Hi Kwan Ray, understand that you have dabbled into some healthcare stocks like United Health. What do you think about Thermo Fisher Scientific? So TMO is a stock that I've been looking into today. So Thermo Fisher Scientific, what they do is they handle all the research stuff. They sell equipment for research. They are basically a large scale company that sells software research equipment. But the problem with this business is I don't understand what exactly is going on with the business. And the metrics itself doesn't look as great as United Health, for example. So for Thermo Fisher Scientific over here, I think it is just completely out of my circle of competence. I can't understand the business enough for me to want to invest into it because I don't know what they sell, what equipments they sell, what research they do, what software they sell. It's a bit hard for me to completely understand this business over here. Although now it is trading at a decent valuation compared to its history, it's currently now trading at around the 23 times earnings, and the mean over the past 5 years has been around the 25 to 27 times earnings over here. So for Thermo Fisher Scientific, I'm looking into this one, but it's hard to understand the business. So it will take some time for me to understand this business before I want to invest into this one. Next one over here, wouldn't integrating Gemini to Google Chrome just give the lead to Google from OpenAI? So yes and no. Gemini is performing quite well in terms of your LLM race. So if you're to look at Poly Markets, for example, Gemini now is leading the LLM's race. But the problem with Google itself is they didn't want all these LLMs to come out back in 2022. So they were slowing all the different developments for all the different LLMs. They didn't want to release this technology because they knew that this could hurt their business. And that was what led to your OpenAI releasing ChatGPT. And that releasing of ChatGPT is what you call first mover advantage, because everyone thinking about LLMs right now will firstly think about ChatGPT, and then comes your Gemini, your Grok, your Anthropic, and all that. So for OpenAI over here, I don't think they will lose their competitive advantage. They are the first mover, and normally your first movers, they stay for a very long time. And for Google over here, they will definitely have some of their market share taken away from Gemini. No one knows how much and whether or not it will affect their business so much that their revenue starts declining. That is when I'll be selling out my entire position in Google, because once their core business declines, then the fundamentals of this business will take a hit as well. But for now, I think Google is an incredibly undervalued stock. If you're to do a by parts analysis like what I did yesterday and the day before as well, Google is extremely undervalued. Google Cloud alone is around a 200 billion market cap already. YouTube is worth around a $300 billion market cap, and Waymo is around a $50 billion market cap. So that is around a $550 billion market cap there already. It is around one third of Google's entire business in terms of its market cap already. And for Google search over here, the current metrics are pointing towards 11 times earnings being priced in today. So I think 11 times earnings is more than reasonable for Google search over here, assuming it's growing at around a 10% over the next few years or so. Hopefully you guys have found this one useful and invest safe.